So I was going into a call one time. I had a therapist tell me, I'm really glad we're talking, but I feel really confident about my current tax strategy. She told me she was a LCSW. She told me, yeah, I was told that if I just buy a bunch of business items at the end of the year, then all is great. That lowers my tax bill. So therefore, I don't have to pay more in taxes. Boy, oh boy. I hope you have not gotten that advice before because that can be a doozy. We walked through the numbers together and she paused and said, after we went through our financial 360, she's like, wait, so I still actually spent real money? Yes, she did. So if you've ever been told that, or you thought, I'll just write it off, this video is for you. I am Alan Pruitt. I am the CEO and founder of the Therapist CPA, and this channel is for therapists in private practice who want fewer tax surprises and more clarity around their money without any overwhelm or shame. Welcome to day 12 of our 30 days of financial clarity for therapists. So let's just attack the elephant in the room straight up and let's clear something up. Write-offs, tax deductions, they reduce taxable income. Yes, which is great, but they don't magically save you money by themselves. A write-off doesn't mean something is absolutely free. A write-off means that you're spending $1 to save a portion of taxes. So for example, let's say you have a 30% tax rate. If you spend $1,000 something that your business does not really need, then you didn't save that exact $1,000. You saved about $300. So you're still paying about $700 for that. Think of tax deductions like a sale. Everybody loves a good sale, right? But a sale is only good if what you're buying you actually need or is beneficial. If you get a sale on something that you won't ever use or don't really need, well, that kind of defeats the purpose of getting a good sale item, right? So that's why write-offs alone are not a tax strategy. Real tax planning looks very, very different because it focuses on how is your business structured? How can you pay yourself? When can you pay yourself? When is your income received? When are expenses timed? And what about long-term strategies like retirement? Where does that fit in? Write-offs should absolutely support your business. And there are great ways that we can do this, but it shouldn't be a reason to spend money that you wouldn't otherwise spend. So often ask my therapist to think about it this way. Would I still make this purchase if taxes were not a factor at all? Think about that. Think about the business purchase you made. If the answer is no, then it might not be the best decision. Proactive tax planning is about making intentional choices throughout the year so that we're not scrambling in December or even April, as we're filing taxes. Once again, proactive tax planning is a beautiful thing. I always tell people there are two tax seasons. There's tax saving season and there's tax paying season. Paying season is up till April. Tax saving season is the rest of the year. So this is really about clarity and not about panic. So we just want you to be informed because we want you making smart decisions. So once again, think of tax deductions like a sale on something useful that you actually need, not to just buy stuff that you don't need at all. So here's one small action that you can take is, where have you been relying on write-offs instead of tax planning? Think about that. Where have you been relying on write-offs and tax deductions instead of actual tax planning? That awareness alone can shift how you approach your finances. So over the next few days, we'll keep building on what real tax planning looks like so you're not guessing or reacting year after year. So if this was helpful, please subscribe for calm and clear financial guidance for therapists in private practice. And if you want to keep learning, please watch our full 30 days of financial clarity. Of course, the playlist is linked. Guys, thank you. Let us know if you have any comments. Be blessed. Bye.